390 billion US dollars. That is the amount Berkshire Hathaway is currently sitting on, which easily exceeds many blue chip stocks' market cap of Berkshire's holdings like Coca-Cola, Amex, or Chevron. So why is Berkshire in such a defensive position? What are the drivers behind this? And may this be one of the most important warning signals? The 390 billion in cash pile of Berkshire mainly are two positions in their 10Q of Q1 2026, called cash and cash equivalents, with around $51 billion in short-term investments in US Treasury bills of about 339 billion, summing up to a total amount of $390 billion. This huge amount of cash was accumulated over several years, starting after COVID and then steadily growing until jumping largely after Q1 2024, since Berkshire was a net seller for several quarters in a row and currently mainly does nothing. In times of hot IPOs and memory chip stocks being hyped up, Berkshire is rock solid and keeps its mantra: be greedy when others are fearful and be fearful when others are greedy. So is Berkshire foreseeing a crash or even a bubble? Well, probably not, since Berkshire isn't predicting a crash. It's revealing valuations, which are, frankly spoken, way too high to justify for a defensive investor. Certainly, there are still bargains in the market for individual investors, as we pointed out in almost every video. But Berkshire can't act like a small private investor, as they literally move markets when they are investing. Thus, it makes it harder for them to identify bargains they can invest in a large amount. In the past few months, we have covered many bargain stocks which still have room to grow even further. Kimberly Clark, a dividend king which is currently recovering from its low in the beginning of this year due to the takeover of Tylenol and Listerine producer Kenvue. Since January, it already gained more than 14% since our first video about it. Canadian National Railway, which rallied 30% from its low when we first discussed the stock at the beginning of this year, and they are still fairly valued at a PE ratio of 23.8 with a 2% in dividends. United Health's revival, boosting its stock up more than 10% since we talked about them as an attractive counterpart to all the AI stocks. And Cisco, the food supplier and dividend king, still trading at a fair PE ratio of around 22 and is up more than 7% since we covered them. With sky-high valuations, investors tend to forget to look at the numbers, as Kevin Kohaki and Jonathan Weil recently revealed in the Wall Street Journal podcast, the true cost of AI hidden in big tech's financials. The issue is all the semiconductor stocks report earnings now, since the so-called hyperscalers like Meta, Alphabet, Amazon, Microsoft, and Oracle are investing where their cash flows are bleeding. That's why Alphabet is issuing $85 billion in new stocks. Many investors see this very critically because Alphabet is not using debt to finance its data centers. Instead, they are using new stocks to fund the data centers, which dilutes the existing investors' stock positions. The reason behind this negative signal are bond investors and banks demanding higher rates because Alphabet's debt quadrupled from March 2025 until May 2026. According to Kevin Kohaki, the most alarming factor is the fact that many large stocks are reporting earnings, but the expenses at the hyperscalers need more time until they show up in the balance sheet as depreciation. But the depreciation has a substantial time lag, thus we don't see them yet showing up in the hyperscalers' balance sheets. Once that happens, the true cost of AI will be visible. Warren Buffett and Charlie Munger were pretty heavily opponents of one metric Wall Streets love to use, called EBITDA. It stands for earnings before interest, depreciation, and amortization. Simply spoken, the EBITDA does not include any cost involved with machinery, buildings, or equipment a company bought and is slowly depreciating over time with earnings the company can harness from it. As Buffettologists, we should, with Kohaki and Wales' findings in mind, ignore Wall Street's beloved EBITDA even more, since this will exclude the depreciation of data centers in the upcoming years, defeating the purpose to truly see the net earnings a stock is making and deciding whether the data center investments do pay out. As we pointed out in the past, the S&P 500's concentration is far from healthy, as Wall Street Journal is underlining it and calls it the AI fiction of the S&P 500. Currently, 36% of the index market cap is represented by the 10 largest stocks, none of which is a non-tech or even a non-AI influenced stock. The issue here is the perception of the balance sheets. As RBC Wealth says, quote, "The largest constituents of the S&P 500 are highly profitable businesses with strong balance sheets, durable competitive advantages, and substantial free cash flow generation." End quote. As this was the current theme at Wall Street, the question is if this statement is fully true, considering the findings about higher than real reported free cash flow from companies like Meta. Since the hyperscalers shifted from being asset-light to asset-heavy companies, they used to have tremendous amounts of free cash flow and capital to invest, which nowadays is all used for AI. As the S&P 500 is currently at a PE ratio of 28, it is valued 30% above its 20-year median PE ratio, which is at 21.5. So how to AI-proof your portfolio with these current market valuation concerns in mind? Sectors like tech and semiconductors are mostly affected by AI, but also energy and utilities like gas turbine producer GE Vernova or uranium enricher Solstice, as well as some industry stocks such as Trane, the HVAC specialist, Vertiv, the data center cooling company, Caterpillar producing the heavy excavators literally building the data centers, and Cummins, the producer of diesel generators, all count as second-order AI plays with lofty price-to-earnings ratios. As Barron's points out, a major AI sell-off isn't likely to benefit second-order AI companies, but instead true defensive sectors. In a normal market phase, this would include utilities, consumer staples, and healthcare. But utilities don't qualify anymore as they count as second-order AI plays. Just look at gas turbine producer GE Vernova, which gained more than 700% during the last 3 years, while its direct competitor, Rolls-Royce, gained more than 800%, and Siemens Energy went through the roof and gained more than 900%. At the same time, nuclear power stocks such as Constellation Energy, BWX, and Cameco all three gained triple digits north of 100%. The two remaining sectors, healthcare and consumer staples, have been neglected and thus have only minor touch points with AI. State Street's consumer staples ETFs trades at a trailing PE ratio of 31, and healthcare ETF trades at 32. While the S&P 500 is around at 28, indicating at a first glance not a crucial undervaluation, but we have to take several factors into account. Both sector ETFs have some anchor holdings, like Walmart making more than 10% of the consumer staples ETF and is currently trading at a lofty PE ratio of 40. The healthcare ETF has 16% exposure to Eli Lilly, which trades at a PE ratio of 43, which is way too expensive for a defensive investor. Additionally, it's important to mention that stocks like Colgate-Palmolive already had a small run-up, but also the earnings dropped as reported in January from 85 cents in Q4 2024 to a loss of 5 cents in Q4 2025, leading to a spike in the PE ratio up to currently 36. Within the healthcare and consumer staple sector, many bargains can be found, which are unaffected by any AI sell-off. And even if AI is still pushing stocks higher, the stocks are in bargain territory, meaning they can give you upside plus safety. As we pointed out, Kimberly Clark, the producer of Kleenex, Huggies, Cottonelle, and all sorts of paper products, had a rough time. The Dividend King dropped more than 37% from its last peak, pushing the stock's dividends to over 5% and is still today only trading at a PE ratio of 21, which is pretty fair for such a quality stock which increased its dividends for the past 54 years. But they started to tumble as they announced the takeover of Kenvue, which is the producer of Listerine, Tylenol, Huggies, and Neutrogena, and was spun off from Johnson & Johnson in 2023. With patience and discipline, Kimberly Clark's recent drop was and still is an opportunity, since this short-term setback is manageable and does not impact its core business, while its long dividend history demonstrates the resilience of its strong business model. That's why Kimberly Clark's stock has already risen from $92 to $108, an increase of about 16%, while its dividend yield was about 5% and still stands at around 4.65%. So the bottom line of identifying high-quality, fair to undervalued stocks is crucial as a value investor. As Investopedia's magazine about Warren Buffett and Berkshire nails it down, Buffett's success wasn't about chasing trends or finding the next hot stock. It was about recognizing durable businesses, buying them at sensible prices, and holding them long enough for compounding to work. From Coca-Cola to Apple, the lesson is clear. Patience, discipline, and focus on high quality have historically mattered more than timing the market or predicting the next big thing. And that's exactly when someone could buy a stock like Kimberly Clark, United Health, Canadian National Railway, or Cisco. For more deep dives in the world of value stocks, make sure to subscribe. Thanks and see you in the next video.